So the markets continue falling, people are scared, especially people entering into the markets for the first time. So I want to take the opportunity to share how my portfolio is going and whether my plan have changed during this market correction. Then, even though I am late to the party, I'm gonna go over the Afterpay half-yearly earnings report with an updated comparables table, and just so that I can make some comments around the valuation. Don't worry, I'll do an update on Zip's half-yearly earnings report very soon. Before I start, a few of you have came up to me and said hello in real life. I'm sorry, I'm a little bit shy in real life, but I am really thankful that you took the time, came up to me and said hello. If you do have any feedback for me on how I can make better videos for you in the future, let me know in the comment section below or email me. And no, this video is not financial advice or recommendation for you to do anything. It's just general information for entertainment purposes. Let's start with a quick portfolio update. As I'm recording this video, my overall portfolio is worth approximately $124,174. And a couple weeks back, my portfolio was worth $136,000. So my portfolio is almost down about 10%. Am I worried or sad about that? Absolutely not. Firstly, I was actually more worried that the markets kept going up towards the end of 2020, and it seemed to me that it was just getting a little bit too optimistic. Well, at least the probability of the markets running really hard was getting really high. And that's one of the reasons why I had cash on the sidelines, since I believed that the markets really needed a breather. So when the market started to correct, it's just nice when the price is becoming less frothy, and it gave me a chance to do some buying at a discount. One of my Discord members described this beautifully. He basically said, imagine buying a tube of toothpaste at $1, and the next day you go back to the supermarket and it's on sale at 75 cents. Would you get mad at yourself that you paid $1 for the toothpaste previous day, or would you just go buy some more? I don't know about you, but I personally would just stock up on it as long as it's a useful good, not toilet paper. Secondly, I'm not too bothered by the market correction because my portfolio is built like a house. I have a save pile, which is like the foundation of the house, and then I have a growth pile. My save pile are in ETFs like Argo, VTS, or WAX. So they are not as impacted during this correction compared to my growth pile. And my growth pile are high conviction companies that I think will be worth a lot more in 3 to 5 years. So I'm not too fussed about short-term fluctuations. And the last thing that really helps me sleep at night, especially during these turbulent times, is that I just don't need the money in my portfolio. The ups and downs doesn't change my lifestyle. If my portfolio do go up, it just means that I might reach financial independence a little bit earlier than I expected. But if it goes down, I'm still going to reach financial independence when I'm 35. The point I'm trying to get at is that when the market was down last year, I invested very aggressively, but I invested just as aggressively to my ability to generate income. So has my investing plan changed because of this market correction and the macro environment? The short answer is no. My plan hasn't changed. I plan to continue investing in great companies at a reasonable price and boost my income so that I can invest more. But it's important to me that I stay open-minded and keep learning about the markets, because who knows when the market correction is going to end. As much as I want to believe that the market correction is coming to an end soon, there's also a chance that it might be extended. And the final question for me and for you is that with the companies in your portfolio, can you sleep at night? I'm very happy with mine, and I have the luxury and flexibility to see my investments pan out in the future. So I've chosen to go with time in the market versus timing the market. So let me take you through my CMC market portfolio and my stake portfolio. So on the CMC market side, it's worth about 79,000 Australian dollars. And like I said earlier in the video, majority of this portfolio is mostly in ETFs. So Argo, VTS, WAX. In my opinion, these are what I think are the safe stuff for me. And then I do have a small growth pile here as well. But as you can tell, my US stuff tends to be a lot more prone to the market correction. So it did go down a little bit, but again, I'm not too fussed about the short-term fluctuations. And a few of you have asked, what is this tool I'm using to track my portfolio? And this is called Sharesight. It's just something that I use to track my portfolio instead of using spreadsheets. I will try and add my stake stuff into Sharesight in the future, but for now I've just kept them separate. Now for my stake portfolio, it's currently worth about 35,000 US dollars, which is give or take approximately 45,000 Australian dollars. Haven't really changed that much on this side, other than the fact that I've added more into Disney as it went down because I just really like the company. I still have about 4,000 worth of cash that I need to deploy. So when I do deploy it, I'll keep you posted. Okay, with the portfolio update out of the way, I want to talk about Afterpay. Now, as of recording this video, Afterpay is trading at approximately 115 bucks with a 32 billion market cap. And I just want to let you know that when it comes to earnings report like these, I find cohort retention, bad debts, partnership growth opportunities way more interesting than the numbers. So that's what I'm going to tackle first, and then I'll look into the income statements and balance sheets. So let's start with the number of active customers. Now, as you can see, the number of customers in ANZ is starting to plateau, but the acquisition of US customers is like a hockey stick. And it's going to reach the moon at this point if it's going to grow like this. At the same time, if you look over to this side, you can see that Afterpay's customers tend to transact 4 times in their first year, 10 times, almost 11 times past their first year, and the rest of these numbers are a little bit cray-cray. But what's damn impressive about Afterpay's model is that they have a U-shaped retention curve. That means the percentage of users that continue to transact on the platform over time increases with time. What we usually see in businesses is not a U-shape, it's an L-shape. An L-shape essentially tells you that this small group of people will stay on the platform, but it doesn't increase usage over time. And of course, the more elevated the L-shape, so comparing the black line to the gray line here, the more of a product market fit is the business. Now, this graph is just even more ridiculous that the percentage of customer spend after the first transaction is even more in later months compared to the first month. Now, between the new Stripe and Squarespace channel partnership, what I'm more interested in is the Stripe partnership, because I think Stripe is a massive growth lever Afterpay is pulling. Because if you think about it, Stripe powers a lot of transactions through Shopify and businesses in other industries. So imagine Afterpay having access to those transactions and what that will do to their customer acquisition if they have access to it. And I wasn't surprised about the Afterpay ecosystem because it was relatively known since they announced that Westpac would be their digital banking partner. And in the earnings report, they did document a customer journey where a BNPL customer will open up an Afterpay Money account, basically depositing their salary and managing all their finances in that account. And then they can create savings goals and then also pay down their BNPL stuff with their Afterpay Money account as well. Well, I took the liberty to expand on that map a little bit to help you imagine their abilities to scale. Now, with the help of a digital banking partner and access to customer transactions, basically Afterpay will get to see money flowing in and out of that account, not to mention the customer's aspirations, which is their savings goal. The power of Afterpay's business model in the future will be to scale horizontally. So let me explain. Imagine you know what your customers want in the future because they're saving towards a holiday, cars, house, or financial independence. Well, Afterpay's advantage is that they know what their customers want before everyone else in the market knows. At that point, because a large volume of customers and data points are flowing through the Afterpay platform, Afterpay can plug in businesses that fulfill these goods and services, let them bid on these customers individually, and that effectively give Afterpay's customers the best deal possible. Not to mention, Afterpay can charge a minor fee for referring these new customers, generating a new high margin revenue stream. Like all BNPL companies, I pay a lot of attention to bad debts, late fees, because that will give you hints of the customer risk profile. And as you can see here, the number of orders are growing quite substantially and the percentage of gross losses is declining. Now this graph can be a little bit deceiving because if the number of orders are growing in such high rate and in such high volumes, then the percentage of gross losses, even though it's growing, is just a smaller percentage of the overwhelming fast growing number of orders. Now in saying that, Afterpay did make an improvement when it comes to their gross losses compared to the same period last year. Now, if we dig into the numbers a little bit more, I'm just not surprised that their total income have increased by 89% compared to the same period last year, and a ridiculous improvement when it comes to their EBITDA as well. Now, even though Afterpay's operating cash flow is negative, and then they mention an adjustment that actually puts the operating cash flow positive, I'm just going to ignore these line items because those receivables are not cash flow yet, but in the near future. On top of that, it's worthwhile acknowledging that because of the current macro environment, especially with rising yields,
Afterpay's minimal cash flow will definitely hurt their valuation, as we can see by their share price adjustments already. So I'm going to talk more about that in the comps table in just a second. Now, Afterpay still have a lot of cash and an incredibly small percentage of warehouse funding being drawn. So there's a lot of capital that Afterpay can deploy to generate more revenue. At the same time, it's also worth noting that as the yield go up, the cost of debt will also likely go up for Afterpay as well. The question is whether Afterpay will absorb that cost on behalf of their merchants, or will they pass that on? Either way, I do think the higher cost of debt will impact Afterpay's business. So we'll see how things pan out. This is a comparables table I use to keep myself posted on what's happening with the BNPL companies. You can always build your own, but this is something that I use. Now, let me just walk you through the different columns. This is just the share price, and percentage of 52-week is just comparing the current share price to the 52-week low. What is that percentage? And vice versa, comparing to the current share price to a 52-week high. What is that percentage? This is just market cap. That's pretty straightforward. Enterprise value, I tend to calculate that myself because the Yahoo enterprise value sometimes is so wrong that I just cannot use. And then the trading multiple is EV to revenue, EV to gross profit, and then EV to total transaction volume. Gross margin is just gross margin. TTM growth rate is trailing 12-month growth rate. And this is revenue growth rate. Now, CAGR just stands for compounded annual growth rate. And this is their revenue CAGR. Now, take these numbers with a grain of salt because these are just analyst projections. I don't know how realistic some of these are. Now, one other thing I want to highlight when it comes to Afterpay is that even after a correction, if you can even call it a correction, their EV revenue is trading at approximately 50 times. But Zip is trading at a 27 times EV revenue. And the question I always have for myself is that why is Afterpay trading at such a higher premium compared to Zip? And for me, the more I dig, the more I think about the differences between their gross margins. And if you compare the two, they're not comparable because the gross margin is so different. Now, imagine you have a business that is a 32 billion market cap company that is going to grow their revenues at 70% over the next 2 years with a 75% gross margin. Those differences are massive over time because at a 75% gross margin, you just have a lot more resources to invest into other things. Whereas when you have a 40% gross margin, you don't have as much resources to invest in other things because it costs you a lot more to service those revenues. So when it comes to the Zip and Afterpay comparison, I just don't think they're the same model. Zip is more closely comparable with Affirm. If you compare those numbers, it actually does look much better. And the final thing I'm trying to say is that if we were to do a true comparison, it will be much better to strip out the QuadPay and compare QuadPay directly with Afterpay. That would be a good exercise. So let me know what you think in the comment section below. So thank you for watching this video all the way to the end. If you want to support the channel, not to mention access to additional content pieces and be part of my fortnightly Q&A, consider supporting the channel via Patreon. Nevertheless, if you have learned something new, remember to gently smack the like button right there, subscribe to my channel so that when I release future videos, you be the first one to know. Until next time, my name is David. Otto will always do the honors and see you very, very soon.